And where this type of candlestick is found, I want to talk about one of the important topic in trading, which is price action. So forget about what you have learned in the past. There's logical way to trade the market. There's a logical way to trade the market, and this is what I am offering you. You understand? So you have to sit down tight and learn how to do it in a logical way. Trading journey, right? So generally, Generally, price action is what the interpretation of market price movement. Why is it a movement? It's a movement because price does not stay. If it stays in one place, you will not make money. Price has to do what we call swing movement, you understand? And this swing movement can be characterized into three phases. We have the bullish trend, we have the bullish trend, right? And we have the bearish trend, you understand? So these are the movement we have. Bearish trend, like forming lower low, lower high, lower low, lower low, like that, you understand? And when it comes to bullish, we have higher low, higher highs, higher low, like continuously like that. Then we have another phase that we call the ranging market. It doesn't go to any direction but move within a specific range, you understand? These are the range, the upper band and the lower band, you understand? So this is typically how the market moves. But I'm going to tell you, there are within this structure, within this movement you are seeing, whether it is trending or bullish trend, within this structure that you are seeing, there are things that made up this structure. And if you can interpret this thing very well, you will trade the market with ease. You will not do it randomly again. And this thing I want to tell you, I'm not going to teach you trend line, support and resistance, everything that you have known before now. No. I'm going to point out things that are logical. So stay with me. So let's go there, right? So these are the logical things that trader focus. These are the logical things that trader focus. Logical trader focus on what? Market structure. Number one, market structure, demand and supply, candlestick behavior, liquidity and price range. You understand? So I'm going to treat all these things for you one after the other, and you're going to have a market, a good understanding of the market, right? You are going to have a good understanding of the logical things that trader focus, not trend line, not any trend line, support and resistance. No, no, no. Support and resistance is not just a single line. You are not the one controlling the market. So how would you go and how could you go and draw a single trend line and expect a single line like this as your support and resistance and expect the price to respect it? Are you the one controlling the market? No. It should be a zone. When it is a zone, it is called supply zone, demand zone, which is what logical trader does, and you are going to learn it as well. So as from today henceforth, you'll not be doing your stop loss. You'll not be trading with just single lines or support and resistance anymore. That is so old, and that is so old school, bro. So let's go. So first we are starting with the market structure, right? First, I would like to okay, let's start with the market structure as we go on now. So I will treat the candlestick behavior. I wanted to treat the candlestick behavior first, but now notwithstanding, let's go and start with market structure. If you could recall when I started earlier, I told you that market moves in what? Market moves in three phases: bearish trend, bearish trend, bullish trend, and a ranging market, right? So let's go. So let me demonstrate this thing for you and show you where you can find the structure in the market, right? So let's use this line, right? This is a line that we are going to use to demonstrate this thing, right? So I'm going to use, I'm going to use, I'm going to use bullish trends to demonstrate this scenario for you guys. This is a bullish trend, right? It's a bullish trend. So hold on, just stay with me, right? Let me draw this analogy. Let's use it to understand this thing perfectly because it is going to help you. The earlier you understand this thing dey better for you guys, dey better for you. So this is a bullish trend, right? Forming higher highs and then higher lows, higher highs and higher lows. So, and I'm going to tell you what you can use to know if a market is in a bullish trend or bearish trend. So as you can see, the overall movement is towards the upside, but you are going to see a pullback along the way. You understand? That pullback you are going to see, you cannot take it as a reversal, right, or as a bearish trend because why? Because the market is breaking structure to the upside. So the moment, let me make this one a dotted line so that it be. So we call this place a break of structure, and this thing is very important because you can use it to know your direction. We call it break of structure, right? Break of structure. BOS. Let me make it bold so that it will be nice for us to see clearly. So this thing is called break of structure. Why is it break of structure? It is break of structure because this previous high swing to the upside, which we call the higher highs, you understand? You understand? When the price return from this place again, on reaching this place, instead of respecting the previous supply level or resistance as the case may be, the price pierced through the previous highs, you understand? And this gave rise to a what we call break of structure. And when this reconstruction happen, as a trader, what are you expecting? You're expecting the trend to continue to the upside. And that is exactly what happened. I'm going to show you what this one represents as we continue. It is called liquidity, but I'm going to explain the concept very deep for you. So at every point in time, you can see that why we take this place as a bull, why we take this swing to the upside as a bullish trend is because there is what we call break of structure at any given interval. You understand? You can see this place, break of structure, right? Break of structure, right? So this thing is what we use to know the direction of the market. You understand? Once there's a break of structure, you know that there's a trend that is active in that scenario. You understand? Vice versa for the bearish trend. So let's go back. I hope you understand this thing, right? If you don't understand it, go back and watch this video again, especially if you're a beginner. You understand? So let's go back and talk about other logical concepts that we would like to treat. Okay, now demand and supply. So I will start by explaining what is demand and supply. Demand and supply are the area in the price where the price move from rapidly. It could be a swing high, it could be a swing low. You understand? So price are in the demand and supply zone, price are expected to move aggressively from this zone, right? Let me reduce the opacity of this so that I will demonstrate it effectively. So this is it, guys. Price is expected to move from the demand zone. This is demand zone. You understand? Some of you call it support. It doesn't matter. So this is the demand zone. Price is expected to move aggressively from this zone. And the idea is that once the price is returning to this demand zone again, it is expected for the price to move upward with aggression. You understand? And likewise the supply zone, right? Likewise, the supply zone. So let's demonstrate the supply zone as well. So, and there's a way you can know the supply zone or the demand zone. For context, let's take this to green, right? Green. So once the price touches touches the supply zone, it is expected for the price to move downward, you understand, to move aggressively from the supply zone. So, and there's a way you can trade this thing with confidence. You can mark it. In my subsequent video, I'm going to bring a great tutorial on how to mark your demand and supply zone effectively. You understand? So this is it, guys. Look like your ID candlestick. This is how your ID candlestick will look like. Let's change this to normal line, right? So send it back, send it back, right? Visual order. I'm trying to get a visual order. Okay, let's just do page down. Page down will take it. So yes, here we have a great candlestick. So the candlestick analogy, there are two parts of candlestick. We have the body, right? We have the body. This is the body of the candlestick. Body. This full green is called the body of the candlestick. You understand? This is the body. Then we have the wick. This is the lower wick, right? This is the lower wick. This is the upper wick. Sorry for my mistakes. This is the upper wick, right? This is the upper wick. And this thing have a story that they are telling you, and if you can interpret it very well, you have a better chance in the market. And this is the lower wick. You understand? This is the lower wick. Lower wick of the candlestick. So this is the anatomy of an ideal candlestick. We have the body and we have the wick. Both the wick and the body, if you can interpret it very well, you have a good opportunity in the market because they are telling you what it represents in the market. So ideally, the market, the bullish candlestick, which is being represented on the chart like this, I told you it is green, so it represents bullish market. A bullish candlestick opens from the bottom, right, and close at the top. So that is how a typical bullish candlestick open, and vice versa for the bearish. A bearish close opens on the top and close below, right? Meaning the buyers are pushing, the sellers are pushing the price from this level down to this place, right? So that is how a typical candlestick here. Okay, let's go further. How, let me show you some of the things that you can use to know the psychology of different candlestick. Okay, let's say this candlestick on our chart like this candlestick on our chart ends up like this. What does this tell you? This means that okay, at a point, this is a bullish candlestick, right? At a point, this candle set down to this place, you understand? The candle set to this place, right? It pushes down to this place, right? But all of a sudden, buyer's pressure comes in and pushes the market to the upside. So this is exactly what this type of candlestick with a long wick and the little body tells you, understand. This is the story that the candlestick is trying to show you. And if you can interpret it, you can trade the market effectively, you understand. They call this type of candle, some people call it hammer, you understand. And some people call it dodgy stone, whatever you want to call it. But just understand that this is the psychology behind it. And where this type of candlestick is found matters a lot. So if the candlestick is found on a supply zone, if this type of candlestick is found in a supply in a demand zone, what it means is that buyers are taking over the market. So the moment this type of candle falls and it closes like this, what you're expected to do as a trader is to wait for the next candle to start forming. At least let the next candle replace to maybe the 50% level of this week, and you start buying up aggressively. So this is how to interpret candlestick. So these are the logical things that make up price action, not trend line, drawing all these things, right? So let's go to another thing, which is liquidity. Liquidity are just pending order in the market. Liquidity and key level are just pending order in the market, right? So let me demonstrate how a liquidity should be, right? Let me demonstrate how a great liquidity should be. Let's go to the chart. Let me use the Euro USD chart, for example. Euro USD chart. You can see, let me put so let me get a good liquidity, right? This let me get a great liquidity. So you can see, if you look at this price critically, you see that the overall order flow is moving to the downside. So this is the overall order flow is moving to the downside. So where is the liquidity in this case? The liquidity is right here, guys. The liquidity is right here. So this is the liquidity, right? These are the pending orders. Sorry. These are the pending orders sitting here. So some people will be putting their stop loss, right? They'll be putting their stop loss around here, believing that once the price come to this zone, right, the price will start falling. You understand? And it is not always like that. You understand? So it is not always like that. The price has to take liquidity before it continue to the direction, to the underlying direction that has been taken before. You understand? So this is the liquidity. This is the liquidity, right? We know that okay, there's a break of structure, there's a current break of structure to the downside. So this is the break of structure, right? This is the break of structure. But then the price will not just continue going down. It has to take the liquidity, the pending liquidity before it goes down. So this is the liquidity here. Price take the liquidity, right? Sorry, this is the break of structure. I want to demonstrate the where is the liquidity. So this place is the liquidity. Price take out the liquidity to the supply zone, boom, and it start falling again. So that is how price move. Price take out the liquidity before it continues to the direction. Once you mark your break of structure, the next thing to discover is the liquidity. So that is how it works, guys. So I think okay, let me discuss the price range. Let me discuss the price range. If you don't understand the liquidity concept, I will come back again to do more analysis on the liquidity. But just know that it's generally a pending order. You understand? It is generally a pending order within a movement. You understand? So let me demonstrate it here again for you guys. So let's demonstrate the price range, right? The price range. The price range. So this what is the price range? You understand? The price range, let me use this chart so that we'll have a good understanding of what I'm talking about. So the price range, when there's a swing point like this, right? So let's say this is a swing point to the upside. If you pull up your Fibonacci from the low to the high of this swing point, you discover that there's a range, the market move within the range, and the range is between the 0 to 100% level, and the middle is the 50% level. So, as a trader, what we are telling you as a price range is that you should not buy at the extreme. You understand? When the market is at the extreme already, you don't want to buy there. You want to wait for the price to return to at least 50% of the previous swing or below the swing, below the 50% level. That is a discount level, and that is a logical way and most reasonable way to trade. Even if in the supermarket, you don't want to buy price of goods when they are so high around this level. You want to buy when the price is reduced to a good level. When there's a discount, you want to go and purchase your product, right? So this is the logical thing that is expected to do on a swing. Sorry, this is a logical thing that is expected of you to do on a swing trade, you understand, on a swing movement or price swing. So guys, with this, we have come to the end of this tutorial. So if you need my assistance, you can join my the Telegram link with the link below. You understand? We help ourselves to learn more about the market, and equally all of us are winning together there. So I want to see you there. Thank you.